How's everybody doing? This is Bob Iacchino from Path Trading Partners along with my co-founder Mike Arnold. And this is a cryptocurrency educational presentation from Path Trading Partners covering the rotation zone. This is going to be part one of the rotation zone. If you watch our videos, if you're a fan of our videos, you hear us talking about the rotation zone. You hear Mike pointing out the rotation zone and the things he would do at the rotation zone. So it's kind of critical you guys have a base understanding what the rotation zone is. And we use it in traditional markets and we use it in cryptocurrencies on the trading side of things. You can use it in accumulation of cryptos as well, but that's something that we talk more about in the shorter videos. So let me go ahead and get started. So what do we use the moving averages for? If you've watched our videos, you see moving averages on our charts and you see Mike pointing to them, talking about a rotation zone. So we use them for dynamic significant levels, rotation zone entries for trending markets, pullback or rotation zone entries to achieve correct reward to risk, targets for trades, and for trailing stops. So the question, what is the R zone? So when you think about price action in traditional markets or cryptos, price does not travel in a straight line. I can't tell you how many times we've had clients say, hey, you talked about buying it, but it went down first. Price ebbs and flows on its way to a target, whether it's a long or a short trade. Price forms a series of waves or rotations, and many times these rotations produce the swings that you see on charts. The swings, in turn, produce chart patterns and trend lines. If you haven't watched our trend line videos, 1, 2, and 3, please stop this recording and do that, and then come back to this. We call areas where rotations are likely to happen the R zone. Obviously, it stands for rotation zone. So where do R zones occur? There are major areas where R zones tend to occur, and those are a return to retest broken trend lines. You may have heard us say that price is kissing a trend line goodbye. That's what that is. Near breakout or breakdown levels formed from sideways channels. If you've watched our videos, you've seen those as well. Near prior areas of consolidation and significant levels. You guys don't know what significant levels are at this point, but we may produce a video for that sometime in the future. And between key moving averages. Not every moving average, not every type of moving average, but between key moving averages. So first, let's talk about what rotations look like. This particular chart has 6 different rotations marked off. And there's probably a couple of more, but we're just marking off the rotations down. This is a downtrend. So you start on a path down and then it rotates up and comes back down. What's a rotation? It's a circle, it's a spin. Here you've got to move back up in the midst of a downtrend and it rotates down again. Same thing here, sideways, slightly higher and rotates down again. Sideways, slightly higher, rotates down again. Sideways, slightly higher, rotates down again, and so on. That's a visual representation of what rotations look like. Seems like it would be a pretty good idea to try and figure out if you could predict where those may happen. So here's an example of kissing a trend line goodbye or returning to test the breakout of a trend line. Here you have an example of a short-term trend line. This is a Path Trading Partners trend line with an initiating point and a defining point. And here you get a close below that trend line. Market moves down slightly to the second trend line and then rotates up to do what we call kiss the trend line goodbye. It touches it, breaks through it even, and then comes back down, rotates up again at the second trend line, and then takes off to the downside. This is an example of what we call kissing the trend line goodbye. That is also a strong rotation. Rotations happen in a breakout from a sideways channel. So here you've got some price action. It goes up and forms a channel. Takes about 3 points to realize that a channel is happening. This one has more than that. Then the price breaks out of the horizontal channel to the upside, sideways a little, angles down, and then rotates back up off of the breakout from the sideways channel. So here you see rotation at a prior resistance becoming support after the breakout of a horizontal channel. That's another thing you'll hear Mike say. We're not talking about that in this video, but you'll hear Mike say all the time, support becoming resistance or resistance becoming support. Here, the top of the channel was resistance. We got a breakout, and when the market rotated down, it rotated back up because resistance became support. Price will also rotate at prior areas of consolidation and or significant levels. Again, we haven't taught you guys significant levels yet, but Here you have areas of consolidation on the prior price action. For example, right here. And you see the price goes down and rotates up and kind of turns back down twice at this area of consolidation from the past. Same thing happens here. You're going to move back down, you get a rotation up. This is a significant level formed by some of this consolidation. Same thing here, moves up, significant level formed by this consolidation and this consolidation, price actions in between it. And also right here, you have consolidation and the market returns and rotates back down again. Here you see it again. Touches, goes up, and where does it rotate at? Prior area of consolidation and a significant level formed by that consolidation. And then the same thing again down here, moves back up. You had some consolidation here and the market rotates at the prior area of consolidation. You also get an R zone between key moving averages, and this is what you'll see Mike referring to most often when he's doing the analysis on our videos. So rotations forming between key moving averages is really the dynamic R zone. That's what we call the dynamic R zone. Okay, so here you have two key moving averages, and you can see prices moving up sideways, and what happens? This is a characteristic of rotations. It's a little bit of sideways movement first, and then you get a rotation into the center of the key moving averages, goes all the way down, touches the bottom, and then rotates back up. A little bit of sideways down sloping price action, rotates back up. Same thing here, same thing here, same thing across, and then it moves back down and eventually breaks it. One thing about moving averages, especially those of you who have not traded much and you're just involved in crypto starting to trade, is you have to understand that moving average crossovers is not really the most valuable use of moving averages. We found that the rotations that can be formed with moving averages are a much safer, higher probability way to use moving averages. A lot of people will tell you when the moving averages cross, I enter a trade. For reasons we're not going to go into in this video, that actually can be a very dangerous way to trade. So we use our moving averages to identify R zones. So what moving averages do we use? Kind of important. We use exponential moving averages instead of simple moving averages. Again, videos we did in the past, an exponential moving average video and a simple moving average video will help you to understand this more. So if you don't know what these two are, stop right here, go watch those two, and then come back to this point. Exponential moving averages are weighted, so the most recent candlestick has a greater impact on the actual level that the moving average is at. We construct our rotation zone with the 8-period exponential moving average and the 21-period exponential moving average. So now, when you watch one of our videos and you see Mike talking about the R zone, you know those two moving averages, an 8-period exponential and a 21-period exponential. We also add in the 50-period exponential and the 200-period simple. So why the 8 and the 21? Many traders and funds look at averages in the areas of the 8 and the 21. The short length averages that are generally used are either the 8 or the 10. The longer length averages that are used are the 18, the 20, the 21, or the 22. So we find the 8 and the 21 to be the best blend to form a rotation zone. Based upon our testing with the trend line entries and other technical patterns and concepts of space, which is the same as a clear path, the moving averages that perform the best are the 8 and 21. So it's based on testing as to why we chose these particular two exponential moving averages to form our R zone. The exponential moving average tested out better than the simple moving average or the weighted moving average. In addition, they fit perfectly in the Fibonacci sequence. If you know the sequence of Fibonacci numbers, the 8 and the 21 are both Fibonacci numbers. So why the 50 exponential moving averages? The 50-period moving average is one of the most popular moving averages. Due to the sheer number of people watching it on their charts, we use the 50-period instead of the 55-period moving average, which is a Fibonacci sequence number. In the Fibonacci sequence of numbers, 55 is a Fibonacci number, but if you ever watch financial news, you'll hear people talk about the 50-day moving average or the 50-period moving average. And to a certain degree, price action trading is always self-fulfilling prophecy, so you can't ignore the 50. So we use the 50 exponential moving average instead of the 50 simple because it is tested out as the moving average that provides more significant. There's nothing we do that hasn't been tested out by us. We don't just do things. We don't just pull things out of the air. We test things, and that's why we use them. So why the 200 SMA? Again, the 200 period moving average is probably the most watched long-term moving average. This moving average, especially on a 60-minute chart and higher, provides a good area of potential support or resistance. We've tested the EMA versus the SMA, and the SMA has proven to be more significant in the 200 period. So again, we don't just pull it out of the air. It's something that we took time to test and look at, and the SMA works better than the EMA when it comes to the 200 period. I'm going to turn it over to Mike to cover the dynamic significant levels. Mike, it's all yours.
Thank you very much, Bob. So we consider the 8, the 21, and 50 EMAs dynamic significant levels because of the same price action tendencies that form at the moving averages, just like at traditional significant levels, which you'll see emotional candles, you'll see tails or wicks from the candlesticks near or at the averages, and you'll see candles running away or through the averages. If you're taking a look at our other videos, it's going to look very familiar, slight different variations of the color, but we have the 200 simple in red, the 8 exponential in orange, the 21 exponential in blue, and the 50 exponential in green, or some shade of those colors. And you can see how the price tends to react. It moves up, came down, found very key support at this 50 and 200. Then you see it goes into a rotation zone, moves sideways, moves up through rotation zone, finally collapses back down, finds the support at the 50. The upper end of the rotation zone, which is mainly the orange and the blue, is resistance, breaks down, travels back in the rotation zone, then collapses all the way down. Emotional candle through the 200, comes all the way back up in the rotation zone, moves back down. You'll see this on plenty of charts and videos that we do. So the moving average, rotation zone, and time frames. Rotation zone on higher time frames are more significant than rotation zone on lower time frames. For example, a moving average rotation zone on the daily chart is more significant than a moving average rotation zones on the 240-minute chart or 4-hour chart, which are more significant than R zones on the 60-minute chart. And you can take that all the way down. I mean, R zones on a 5-minute chart are very, very minor compared to a daily chart. Trending price action and moving average rotation zones. Moving average rotation zones are significant when the market is trending. The stronger the trend, the more significant the rotation zones will be on shorter term charts. A very strong trending market might respect the rotation zones on the 60-minute chart and not pull back enough to enter the R zone on the 240-minute chart. Or it might pull back into the R zone closer to the 21-period exponential moving average on the 60-minute chart, which is close to the 8-period exponential moving average on the 240-minute chart. This is why it's also important that you do some multi-time frame analysis and not just look at one time frame, but combine like the daily, the 240-minute, and maybe the 60-minute, depending on what time frames you like to trade, to get an idea of where it is in all the different zones on all the different time frames. So what happens when you're in congestion? What do the R zones and moving averages do when you're in congestion? When a market enters into an extended period of consolidation or congestion, the moving averages will begin to converge and tend to go flat, centered around the middle of the congestion. Now, they'll move back and forth. They're not going to be a flat line, but they'll be wavy right around the middle. Especially the longer ones will flatten out more than the shorter ones. When we see that happen, we ignore the rotation zones and wait for the market to get out of congestion. The easiest way to see this is when the market forms a horizontal channel price congestion. Another sign the market is in congestion or consolidation is that the moving averages will also cross back and forth repeatedly. This is why we don't trade moving average crosses, because you can get chopped up with long and short entries. Here's an example up at the top. Moving averages are converging and going flat in the horizontal channel. You can see especially the 8s going flat, sitting right in the middle. Finally, it breaks out of the horizontal channel and the moving averages start to separate, creating another rotation zone, moves down, comes up, tests the rotation zone, then moves up. Now we go into they go flat in this. This is a raising flag pattern, okay, which is generally a continuation pattern, but as it goes up and forms the congestion or consolidation in this raising flag, you'll see they go flat again. and then it breaks out of that flag and they separate. Come back down, test the rotation zone, come down and actually technically form a double bottom, move into consolidation, horizontal channel, where they're flat again. This is where we ignore them. Breaking out of the channel, we start to observe them. You see it testing once, and this is also what Bob talked about earlier, breakout and retest that horizontal channel area, moving up, testing the rotation zone, coming back in, testing the rotation zone, and moving higher. Breaking out of congestion. When the price action breaks out of congestion, the moving averages will start to separate. If the price follows through with the breakout or breakdown from congestion, then it's time to start watching the moving average R zone to provide potential support and resistance. Just because price enters the R zone does not mean there is a trade. A valid trade setup and trigger still has to occur. That might be like a pullback and might form a double bottom on a shorter time frame, or it might give you a trend line trade. It might give you a divergence trade if you know what divergences are and use some technical indicators. But you're not just buying it because it goes in the rotation zone. You're going to want something else to trigger the trade. Price violating the EMA R zone. When we see a price move break through the EMA R zone and continues into space or a clear path, we look for the next possible target to be the 50 EMA. Keep in mind that if the 50 EMA is far away from the current price action, then there might be a closer valid target like the end of a clear path move or a trend line. So let's put some of these concepts together. Comes up, gets above the R zone, which is also flattening out here. So once we get back down beside, we'll start ignoring it. It tests the 50. We get out of this consolidation, little sideways move, lets the 8 catch up and moves up. Then we dip down, get below the R zone, and we're watching for the 50. The 50 finally comes in and gives us very strong support. And you'll notice again, we have a flat rotation zone in the middle of this horizontal channel or congestion. We break out of it, and you can see we can draw a line up here. We break out of it. The R zone starts to separate. We come back to the R zone and also retest this prior resistance coming support. R zone move up, R zone move up, come up. R zone move up, new high, then it breaks below it. The moving averages cross, and now the R zone is providing resistance again.
So in this video, we looked at the concept of where the rotation zones tend to occur just based on price action. We then looked at the concept of building a rotation zone, or R zone as you'll hear Mike call it, based on moving averages. We examined the additional moving averages we put on our charts, the 50 and the 200. Remember, the 50 is an exponential as well, but the 200 is a simple. Finally, we started to examine the concept of where the R zone is valid and when we ignore the moving averages. We'll put out a part 2 to this video, but in the meantime, if you want to reach out to us, you can follow us on Twitter at @PAF_trading, like us on Facebook, it's up there, and there's our website as well. And go ahead and sign up for everything that's free on our website. Love it if you would listen to our podcast, but more than anything, hit like and subscribe on these videos and pass them around to keep this channel growing. Cheers, everyone, and thanks for watching. Look out for part 2 soon.